Coming up today, stocks decline as inflation comes in hotter than expected. Jobless claims soar to a year high. Is the Fed changing its tune? A look underneath the hood of inflation, all the reactions across social media, an update on China, Nvidia approaching all-time highs, what to expect from Robotaxi launch, and did Jay Powell just make a big mistake? You can't miss this one, guys. Let's go. And welcome back everybody to the daily market review on this big Thursday of news. Got quite a lot going on today. Jobless claims, inflation, Hurricane Milton, Robotaxi, Nvidia pushing up to highs. We've got bank earnings coming tomorrow. On the cusp of a response from Israel towards Iran. More news coming out of China. It's all happening here today. Option dealers did get it right though. They forecast really low volatility today, and that's exactly what we got. S&P 500, 5780, and like the rest of the indices, just traded a bit lower. Market really digesting well, inflation coming in hotter than expected, giving us all a little bit of a surprise. And stick with me today, because I'm going to dive into all of that a bit later on, including the market's changing expectations on inflation now, climbing back up at a quick pace. So I'll show you a few charts on inflation. We're also going to be talking a little bit about the volatility market today and what that's telling us, as even though markets are trading real calm, looking at implied volatilities, especially in oil, the markets are still on edge as we're heading into a really dicey time the next few weeks. And so I'll give you an update on all that, including crude oil. I'll also get you up to date on what's happening with China, the latest news from them, along with a bit of a preview on the TSLA Robotaxi event, which is scheduled to come out later tonight, a little bit after this video is released. And we'll be talking about the resurgence in the AI trade, Nvidia pushing back up to all-time highs. First off, let's just talk a bit about some of the most important news we got today. US jobless claims soaring to a year high. However, the data's been skewed by Hurricane Helene, which just hit Florida a few weeks back, and which the state has still been trying to recover from. Then they just got hit with an even bigger one, Milton, which recent reports are suggesting didn't hit as bad as what some estimates had been showing. So I guess that's a good sign. But the point for us investors, I wouldn't look too much into this jobless claims report. It is a bit of month-to-month noise. We can see that by the week-over-week percentage change in jobless claims and that hurricane's path. You can see it really affecting Florida and the Carolinas, all the way up to Ohio, Indiana, Michigan, and Wisconsin. Saw a spike in weekly jobless claim. And this is why you still have to pay attention to the fundamentals. Because if you weren't looking at that news, you were just looking at a chart or a systematic strategy that can't see that news, it's not a good sign to see jobless claims spiking up to a multi-year high. This is another reason why we use moving averages to kind of smooth out the trend and the month-to-month noise. Because if this wasn't distorted by the hurricane, that's really not a good sign, and we especially don't want to see the 3-month or the 6-month moving average cross above 250, because looking back in history, apart from that crazy spike from COVID, going back in the previous recession, that's kind of what happened, like we saw in mid-late 2007. Weekly jobless claims, bottoms out, breaks out, higher highs, higher lows, moving average curling up, and then we're in a full-blown recession. However, more important than jobless claims today was CPI inflation, which came in hot across the board. I was expecting it to come in line with core inflation year over year at 3.2. Actually came in at 3.3. Same with month over month, 0.3 versus 0.2. And same with headline inflation as well. Hotter than expected. And so while it's still too early to jump to conclusions and get super worried right here and now, there's just a few signs out there in the market that inflation could be curling higher. Looking at Truflation's latest readings, had a sharp bounce off the lows. We were just at 1.5% about a month ago. Just like bond yields, we've done this big jump up. In fact, I've just put a vertical line here on my chart, 18th of September, when the Fed did their controversial 50 basis point cut. The day before that, 10-year was at 364. Here we are, not even a month later, already slapped on more than 40 basis points, back to a 4 handle. Same with inflation expectation. Looking at inflation-protected treasuries versus regular treasuries. Spread just shot up ever since the Fed loosened monetary policy. And so I heard some people say, oh, the bump up in inflation because there's been a bit of a rush out there, especially in Florida and surrounding states. People scrambling for supplies, stocking up on groceries and whatnot. And of course, that's all taking place. And that's showing up in grocery spending data, especially in the impacted states last month and continuing into this month as well. So no doubt that is having upside pressure on pricing for the here and now. Also doesn't bode well for the short and medium term, as hurricanes are inflationary. They deplete supplies, cause a lot of demand for fixing, renovation, repairs, and people stock up on supplies. However, the bad news is that's not what's causing this bump up in inflation right here and now. Because when you look at Core CPI inflation, and basically Core strips out all the volatile items of food and energy. Core basically just looks at services, education, recreation, medical care, transport, utilities, other personal services. Keep in mind the US is a services-driven economy. Month over month came in 0.4. You can see here in the black line, bumping up here, with the biggest increase coming from transport. And so it's no surprise we're getting some rhetoric out of the Fed today, Bostic in particular, saying he's willing to keep the door open to actually skipping a rate cut in November. Seems like they're not really sure what sort of path they're on, nor are all their members in agreement. He went on to say, I'm totally comfortable with skipping a meeting if the data suggests that's appropriate. So are they really just playing this month to month? Don't they have a grander vision? Aren't they more confident in their path? Or are they just swing trading this data? Because even though I wasn't expecting a bump up in inflation right here and now, crude oil has been trending down for the last 6 months. In fact, getting down below $70 a barrel, and we're already getting a little bump up in inflation here and now. What happens if oil keeps going back above 80? What happens if China's flood of liquidity causes a big increase in demand for oil and other commodities? What happens if we continue to see more hurricane and their inflationary effects? Also got the stock market at all-time highs. The top 20-30% of asset owners still cashed up and spending, depleting supply. Could be setting up for potential resurgence in inflation over the next year or two. Because just look at that change in the US government bond curve. Today in the pink, a week ago in the blue. Durations down the bottom. 1 month, 6 month, 1 year, all the way out to 30 year. Been quite a quick repricing. Not to mention wars as well are also inflationary. And so here's a look at a monthly chart of United States core inflation rate year over year. Came in at 3.3% today. So like I said, too early to start getting overly worried, jump into conclusions. Still technically in a downtrend. We only may be potentially basing bottoming here. We'd have to really curl back up above 3.6, maybe 3.8 to start saying, okay, maybe inflation's bottomed out. But just looking back in history, as I scroll back in time and zoom out, inflation is quite wavy, and like the unemployment rate, it can often change and spike and dive really quick as well. And so if you draw some comparisons to inflation back in the 70s, and say this point in time was similar to 2022 when we shot up to 9%, it's actually a lot higher if you use the same methodology they used back here, where they took into account much more of costs around housing. But anyway, it dropped back down, and the Fed thought they had inflation under control. They started cutting rates again. So if, for example, we are tracking a similar path, maybe we're at a point in time similar to July 1976. And if so, we very well could do this path in inflation over the next 2 years. I would say that's kind of the best case scenario, considering we have a few things different this time. Number one being record government spending, record liquidity from the Federal Reserve. There's so much currency out there, kind of hard to see inflation dropping like a rock back under 2% again. But let's say they were able to keep it tame. Maybe we get a recession that helps to keep inflation down next year. They keep dropping rates. They would have thought back then, gee, I'm glad that's over with. That was horrible. 10, 11% inflation. Only to help set up an even bigger and second wave of inflation going into 1980. So if we were to follow that path, maybe inflation really takes off later next year or into 2026. Then come 27, 28, who knows? We could be back on an 8, 9 handle. Don't think many people are expecting that. And if that were to occur, commodities, energy stocks will definitely be some of the best performing assets out there. And just looking at some reaction to the CPI print from across the financial community on X, Charlie Bilio, the most absurd number in CPI. According to the government, the cost of health insurance has declined 33% over the last 2 years and 11% over the last 5 years. And I'm sure some of my viewers may disagree with that. I'm interested to hear from you guys. Has your health insurance declined 33% over the last 2 years and 11% over the last 5 years? Because according to plenty of comments here, and what I hear from other people actually on the ground, it's just simply not the case, which kind of just questions the integrity of these numbers or how they're able to play around with technicality to give a good headline print. Charlie went on to show reported CPI increases over the last 4 years. Apparently medical care is only up 8%, food at home 22%, electricity 29%, home prices 47%, auto insurance almost 60%. And so if that's what's been reported, that's probably the best case scenario. We got another investor posting today. Jobs and CPI data are really making Powell look like a dummy. And it's kind of strange, isn't it? Did this catch Jay Powell and his team of 500 PhDs, data scientists, economists, sitting there all day looking at this data, talking to departments? Did it catch them all by surprise? They didn't expect inflation to curl back up, unemployment to come back down? Because when we got the presser from Jay, kind of felt like maybe there was some soft data around the corner. And he just stopped short, wisely so, of declaring mission accomplished on inflation. But like I said, money doesn't lie, especially the bond market, 10-year. Up almost 50 bips since the Fed cut. According to Goldman Sachs, they forecast year-over-year core CPI of 3% in December. And they too think it's going to drop in next year. But like I said, an absolute absolute terms, global liquidity pretty much at all-time highs. 107 trillion, and global money supply is increasing year over year. Central banks are loosening up again, and we could be on the doorstep of the mother of all stimulus and quantitative easing coming out from China. And it just so happens when there could be a potentially changing narrative in the markets of inflation expectations, the energy sector is just coming off extremely oversold levels relative to the rest of the market, like we can see here in XLE. It's like we bottomed out about a month ago in September here, getting some strong green candles coming up. Same deal with the oil and gas sector. Get some good momentum thrusts off this low. Gold mine is still on a nice uptrend as well. Of course, the industrial military complex has been doing well this year. And so we've seen that big rotation in energy over the last couple of weeks. Just looking at my sector breadth table indicator, you could think of the 5 day as the immediate term, 20 as short, 50 as medium, 200 as long day trend. Even though we've got a little pullback the last few days in energy, still the number one sector above the short-term trend, 95% of all energy stock above the 20-day moving average. Coming in a close second to financials, 90% of energy stocks above their 50-day moving average. And what you'll find quite often in markets is breadth leads price, because a lot of indices, they're dominated by a few stocks. And so when you look underneath the hood of the market, what all stocks in a sector are doing, you get a much better picture for where the strength and weakness is. And so in the short and medium term, energy stocks are still performing the best here. Like I said, after they've been in a bit of a downtrend, we've also seen quite a strong bounce back in tech these last few weeks as well. But we've got a lot happening at this point of time, just a few weeks out from a really hot election come the 5th of November. Just looking at this article on Barron's today. What happens to stocks if Trump or Harris wins big in November? They start with a baseline that regardless of who wins, the government will remain overall divided between Democrats and Republicans, and the Fed can still achieve a soft landing and there isn't a recession. And so a lot of fund managers are saying pretty much doesn't matter as long as there's a divided government between the White House and Congress. So of all the scenarios, UBS considers their baseline is the most optimistic for stocks. They also crunch numbers if there's a so-called red sweep. Republicans take both the White House and Congress, or a blue sweep, in which the Democrats do the same. They say the Republicans could introduce trade tariffs. They think the S&P will drop to 5,200 next year, but Republicans also seem more likely to reduce regulation and cut taxes. When both branches of government but don't follow through on tariffs, stocks would do much better. In fact, we'd be looking at almost 6,400 next year in the S&P, even higher in 26. And UBS said stocks won't do as well in the scenario of a Democratic sweep. See the S&P at 5,750 next year. And so some other things being talked about by Wall Street. If Republicans win the White House, it's probably a tailwind for the oil and gas sector, fracking, looser regulations, good for financials. On the other hand, a Democratic win may be more better for things like education, renewable energy, and potentially big tech as well, as the Republicans may look to crack down on them. But overall, if it's a divided government, it shouldn't have that big an effect overall. Economy largely runs itself. There will be pockets where things can take a big change. But like I said, the stock market is digesting all of this so well. We're still pretty much sitting at all-time highs here on the SPY. Even though inflation came in hot today, yields are climbing back up, oil's bumped back up, Middle East escalating, a couple of weeks out from election, stocks just don't seem to care. They're not moving around all that much. And you can see that in the realized volatility index. Been decreasing for over a month, only moving around annualized rate of 10%. However, the VIX still holding onto a 20 handle, and it may stay bid right until the election. And so that's given us a rather elevated volatility risk premium. Option dealers asking for 10 points over realized to sell option contract. And that's pretty high looking back in history. Typically when it nosedives is a good sign for the market, like we've seen in previous market bottoms. Option dealers forecast volatility dropping. When stocks rise, they start selling options for implied volatilities below realized. However, we have the opposite here. So in other words, option dealers are demanding a premium to sell insurance here because they're not sure what's around the corner. Middle East, the election, they're demanding some compensation for that. So we still could get an uncoiling in the stock market here. Very well could get a quick rug pull, red candle, and I'm sure that would spook a lot of people to sell just because of the global macro setup. Going into the election, the Middle East, inflation curling back up, good reason for a lot of people to sell, or at least get nervous. And there's no hiding out in long-dated bonds either. TLT's been falling for a few weeks. Looking a little short-term oversold here on my indicators. However, quite a lot of upside pressure on yields. Not sure I'd be buying TLT here for either a swing trade nor investment. In fact, I don't own any bonds. I haven't for years. Apart from a few swing trades, I really find the idea of owning bonds unappealing. They used to be defensive, however. Do you really want to lend to the government for 20 years? When inflation can just destroy your principal. Forget about the coupon. There's a look at the dollar, bouncing back up. It too a little short-term overbought, but the bond market overall is really chill. High yield spreads over treasuries, 2.94 point. Really no stress there at all. High yield bonds still on a technical uptrend. And this is not just limited to the States either. We've got global yields climbing. There's the UK 10-year bouncing back up to 420. Little bounce there in the Euro 10-year. Not too much. Canadian bonds, the Aussie 10-year, Japanese 10-year, and we've even had a little bounce in the China 10-year as well. Still really though, most definitely not out of the woods for China. It's going to be a long process. And speaking of China, the markets seem to find some footing today. On the news I reported yesterday, they've penciled in a meeting this Saturday from the finance minister, in which they may unveil some more stimulus. In fact, they've been feeding the markets little bit by bit, pretty much every other day, and they really kicked this off as soon as the Fed cut 50 basis points, which, like I said back then, wasn't a coincidence either. With the declining US dollar, I think they're trying to invite capital back into their market. They may have seen America loosening up and wanted to use that as an opportunity. People's Bank of China just set up a pretty sizable 70 billion lending facility. Security fund insurance companies to buy stocks. They want their companies to buy stock. They want their property and stock markets to go back up. And in my opinion, they're going to do everything they can to ensure that's the case. They're sick of this huge divergence between their economy and the capital market. It's not good for them. We also just got news. Their Ministry of Justice released guidelines for the private economy, backing private sector involvement, ban unlawful administrative or criminal actions in economic disputes, and a few other things. Kind of loosen regulations and monetary conditions over there, trying to stimulate investment again. And just keep in mind, not just in China, but all around the world, typically when governments spend money, it's good for market. Just inflates everything. We can see back in history, whenever China does some fiscal stimulus, it does really well for the stock market, looking out about 6 months, on average about 10% higher. However, like I've been saying, this is not any ordinary stimulus package. Like I said, we could be on the cusp of the mother of all fiscal stimulus packages. Like I said, stringing piece by piece for their stock and property markets. Mostly monetary stuff. Now we're getting more of the local government stuff. Still waiting for the big bazooka from up top. So like I said yesterday, this zone here, it's about a 50% to 65% retracement of this move. What we typically see markets do. The market may just coil up going into the weekend, and it all really depends what we get on Saturday. Could be a nothing burger, just coming out with some language but no real big numbers, or who knows, they could fire off the big one and back up we go. Either way, it's going to remain volatile, but this is still a monster move. And in fact, just looking at the most popular China traded ETF in New York, FXI, that hasn't even quite done a 50% retracement of this move yet. It's held up a lot better than the actual underlying index. In fact, it hasn't even touched the 50-day, this entire pullback. So for sure, it could have a little bit more to go. Could be a chance for time to catch up to price. However, in my opinion, if we were to take out a lot of these gains, we're definitely going to see some big measures coming out of China. As in my opinion, they're really determined to get underneath it. And just moving on to Hurricane Milton, it was good to hear that it likely did less damage than feared. I'm sure a lot of people are still dealing with some of the worst situations out there though. So hopefully there hasn't been too many casualties, but the economic damage could still be significant. There was some estimates coming into this. Could be 100 billion, 150. However, now they're talking about 30 to 40 billion, which is pretty good news for the insurance industry. Did sell off hard coming into this week, Monday. How it's actually bounced back, doesn't seem to be much of a reaction there in insurance stocks. And in fact, Generac, the generator maker, actually fell 3.5% today. So it looks like the market is pricing in. It wasn't as bad as what some estimates were telling us. And moving on to the AI trade, which looks to be back in full swing. Nvidia on firm footing, pushing up to all-time highs after they had their AI summit in Washington, D.C. this week. Looks to be well received by the market. And we're getting some research showing that the AI market could absolutely be head and shoulders above the opportunity we've seen in cloud, mobile, the internet and PC. Some forecasts saying it could be a 20 trillion plus market opportunity, as AI is pretty much touching all of our lives, and just about every business and industry out there can benefit from the efficiency and productivity gains it offers. We're also just hearing reports that Nvidia's Blackwell chip is sold out for the next 12 months. In a meeting with Morgan Stanley, Nvidia executives revealed that the Blackwell chip is sold out for the next 12 months, and they still think their market share can grow. It's simply incredible, the dominance and growth and margins of Nvidia. There's a look at the daily chart. Now just touching this resistance box at 134. All-time highs just above 140. Certainly taking a look at it. And like I've been saying for the last week and a half, we've got a lot of bullish seasonality surrounding the stock. Earnings still a little over a month away, but it's definitely leading the semi-sector. Although that's sitting at multi-month highs, still has a bit of work to do to get back up to those all-time highs of what looked like a bit of a double top on those big bearish engulfing candles. But the sector overall has some bullish seasonality over the next couple of weeks and couple of months as well. We also just heard today AMD's rolling out a new AI chip to try and compete with Nvidia. CEO Lisa Su believes they're closing the performance gap with their largest competitor. I've heard a lot of people say that AMD is going to catch up. However, the market didn't really agree with all that today. Stock actually finished down 4%, but has bounced pretty well, like a lot of the industry from the 5th of August. And there's the largest manufacturer of chips in the world, Taiwan Semi. Not too far from all-time highs either. And a look at Intel, still trying to bounce up off this bottom. Do look to have signs of accumulation. However, it still looks to be trading a little heavy. What's really been on fire? Palantir, just ripping up as more and more companies and governments around the world adopt their platform. They can plug in all of their data, billions of points of data, so they can better understand their businesses and organizations, make better decisions, drive more efficiencies, scheduling staff, scheduling assets, predicting maintenance, you name it. The benefits are endless. And Palantir is one of the best, if not the best, at doing all that. And so even though semis and chips have been weak for a few months, Palantir certainly has not. It's been an absolute rocket show. Now up 80% after I first added it to my stock picks portfolio back in early June. And no doubt we're getting a little stretched here in the short term. Just fired off my first reversal signal today. Probably a lot of people jumping on board. So we could be close to a pullback or consolidation. However, this price action, pretty strong, especially these big, thick green candles. Accumulation bodes well for the medium long term. And so as per usual, I'll just be riding this long as it stays in an uptrend. And I just use my fundamental and technical indicators to guide me on that. Because even though it's certainly not cheap, in fact, my fair value has it 100% overvalued. Thing is, markets can do crazy things. Just because it's 100% overvalued doesn't mean it can't go to 200%. And that's why, first and foremost, always follow the technicals. Follow the trend. And so if you'd like to get access to my stock picks portfolio, see all my current open picks, along with my deep dive research on all of them, along with weekly updated performance of how my new investing account is going, and click the link below this video, head on over to my website, clickcapital.io, and you can save 30% off a yearly plan. Just use coupon code PLTR, and you'll be added to my private members list and get my weekly stock picks and research in your inbox every Sunday morning, along with access to the private members area. And so far, so good. Portfolio is currently up about 10%. And time-weighted return since I started it in June. And so I buy $500 of a new stock every week. And anytime I sell, I reinvest the proceeds equally back into all open positions. And that basically allows me to pyramid winners, along with keeping a really smooth equity curve. And that's why weekly dollar cost averaging works well. Because since I started the service in June, I haven't had a down week in dollar terms. Even though, of course, I have in percentage terms. It's just a lot psychologically easier when you see your account going up every week. And my contributions into it are set on autopilot. Direct debit from my account, so I treat it like a bill. Don't even really notice it. So if you'd like to follow my portfolio in real time, then just head on over to clickcapital.io and use the coupon code PLTR to save 30% off a yearly plan. Okay, so it appears Tesla is unveiling the Robotaxi prototype a little bit later on tonight. In fact, a few hours after I finish making this video. And if you want, you can watch it. It's going to be streamed live on the Tesla page over on X. Just Google Tesla X and you'll find it. So there's a lot riding on this. We're going to see Optimus Bot. Hopefully there's no stuff-ups, no mistakes, like the Cybertruck when the window broke. Could be Elon Musk in the Robotaxi with someone else, giving a demonstration. And this is one of the most anticipated events from Tesla in a long time. It's been well talked up. Elon was hoping to unveil this even a couple of years ago, for which he's been heavily criticized on. But this is big stuff if they can pull it off, and both impressing the market and actual numbers, which are still going to be years away before we really know how this actually plays out. But if the street and investors are convinced on the technology, maybe they'll bet on the execution as well. Stock can trade up on a premium because it's certainly not cheap here either. Still over 700 billion in market cap. Still worth more than the entire automotive industry put together. And this will be interesting to see how this plays into the ride-sharing industry, because Uber tried to get into automated driving. However, they had an accident, which unfortunately someone was killed, so they gave up on it. And I think their play going forward is just going to be wait for others to develop the tech, maybe partner with a few of them, and they'll just adopt the technology and use it under their brand. So in a few years from now, and it's already starting in some cities, there'll be robo-taxis picking us up and dropping us all around town. Still be human drivers for a few more years yet. However, competition will be coming from the robo-taxis, and like most markets, people will just go to where's cheapest, where's the quickest, what works best for them. And so I'll be watching it later on. Anybody else interested can take a look. Otherwise, I'll summarize everything we've seen in tomorrow's daily market review. And there's a look at the stock there. Did a bit of a hammer candle today. Just going down to the 5-minute chart. Did dip down in early morning trading. Found some support. Just kind of bumping around here a bit. And I'm inclined to think this could be bullish. Of course, I could be wrong. No one can predict the future with 100% accuracy. However, if they deliver a flawless presentation, looks really good, and convinces us investors, they might actually have a shot at pulling this off and dominating this. There's no reason why we can't slap on, who knows, 8-10% tomorrow, trading back 260, 270, who knows, all-time highs. However, if they stuff something up, the market's not convinced, we may end up gapping down the other way. Like I said, I'm not an ultra short-term trader. I don't day trade. I only swing trade and invest. And so I'm not betting on this, but if I was, I'd probably favor the bulls here. But of course, I'm biased because I'm a long-term Tesla believer. So let's just wait and see what tomorrow brings us. Moving on to the situation in the Middle East. Wall Street Journal just reporting Iran's given a secret warning to the US allies. Don't help Israel or you're next. The threats through diplomatic channels have prompted Arab states to tell the US that they won't aid any attack on Iran, not allowing the Americans and Israelis to use their airspace or their military bases to launch attacks on Iran. They just kind of want to stay neutral on this and let it unfold how it's going to unfold between the two sides. In which we're just hearing reports now. Apparently the Israeli Security Cabinet is expected to issue final approval tonight for a retaliation strike against Iran. So we've been hearing this for a few days, if not over a week now. They're on the cusp of an attack. Seems they can't really decide, or the Americans are pushing back. Seems they really want to do something, but the current US administration is trying to reel them in. It's not really a good time to see fireworks over there at this point. Nonetheless, there's still plenty of volatility in the oil market. The oil VIX over 50, oil popping back up today. And it all really depends if Israel attacks their energy oil infrastructure. Even if they don't, oil can still stay bid on fears. But if they do, and I don't think they will, because it'll very much upset the current administration with them, we could see oil spike to, who knows, $80, $90 a barrel overnight. That's why I don't think they'll do that. I think they'll just go for probably a more watered down attack on a few of their bases they use to launch missiles to try and stop any further missile attack. Of course, that's just my opinion and speculation, but again, they may wait for markets to close tomorrow night, do their attacks, and give time for the world to digest it before futures open on Sunday night. May get a few announcements come out before then as well to try and cool things down. But then the ball will be back in Iran's court. Are they going to go big again? Because if they do, in my opinion, Israel won't really care what the states tell them. They're in a full-blown war, and they'll just go for it. And all this is likely keeping a little bit of a bid in gold as well. Just a slight pullback this last couple of weeks. Still sitting above the 50-day, and it too has a little bullish seasonality coming into it. And there's the commodity index as a whole, bumping back up these last couple of weeks. Wonder how Jay Powell feels about all this. Ever since he cut rates, markets have gone, whoops, inflation. But of course, that jobs and CPI report caught him by surprise, right? Looking out to the economic calendar tomorrow, got the unemployment rate coming from Canada, expected to be 6.7%, quite higher than the States. And then PPI, a little bit more inflation data, along with the consumer sentiment survey. See how all that comes in. And interestingly, Fed Fund futures still pricing in a majority chance the Fed will still cut quarter point when they meet next month. And that's pretty much a wrap for the daily market review, everybody. Thanks very much for tuning in. I hope you enjoyed today's show, and I look forward to breaking it all down for you again this time tomorrow. Cheers.